Amazon stock is hemorrhaging following their first quarter 2022 results. Stock's down about 13% today, down about 30%, nearly 30% year to date. Investors are wondering if it's time to back up at the truck. In this video, I'm going to talk about their different segments. For example, how when you consider their AWS segment, you're effectively potentially getting their other business lines like both offline retail, physical shopping like their Whole Foods stores, as well as their online commerce. They're on the core Amazon that everyone's so familiar with. You're effectively getting these assets for free. And so then the question is Amazon, AMZN, potentially a deep value play? Is this the time to be backing up the truck? So I'm going to talk about why is the stock down, as well as an overview of their valuation, looking at these individual segments to try to figure out where does the stock potentially go from here. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Let's dive right in to understand what's going on with Amazon. So yeah, the stock's down a bit today, following arguably just weak results. Talking about 7% growth in sales, consolidated sales. They say 9% when you factor in that the US dollar was quite strong during the quarter. But the challenge with that is, so you have 7% growth, but you also have shares, getting issued. So it's arguably even worse, because on a revenue per share basis, it's not even 7% growth is sort of what you're looking at. And the challenge here is that, look, it may not seem like a lot going from 519 million shares outstanding to 523 million over a year. But when you're a $1 trillion company, that is still a heck of a lot of dilution, effectively stock-based compensation. And you layer on this slow growth, continued dilution, and the fact that here it is, they talk about their long-term goal, optimize free cash flows. And, what are you looking at here? Their free cash flows are down 297% year over year to $30 million in cash burn over the last 12 months. Now, this can be attributed to the fact that they've been investing significantly in the business to keep up with demand during the last 2 years of pandemic. And arguably, thank goodness that Amazon was available for service during the pandemic. They talk about during this period, we doubled the size of our operations and nearly doubled our workforce to 1.6 million employees. That's just an incredible amount of expansion that they've had to do to keep up with demand. Labor and physical space are no longer the bottlenecks that we thought they were throughout 2020 and 2021. This is an interesting point. This might be a read through to where the economy is heading, potentially an uptick in unemployment, let's say in the next six months to 12 months. If you have big employers like Amazon saying, it's really just not a problem going forward for us to find, employees, we're set now. And so that is a really interesting data point to consider, as you consider the macro. But in terms of cost pressure and why they swung to such a huge loss, investing in their business, not only with, number of people, but you also see the inflationary costs with just raw goods. The cost to ship in overseas containers more than doubled compared to pre-pandemic rates, and the cost of fuel is approximately 1.5 times higher than it was even a year ago. Talking about year-over-year increase in wage inflation, so not only hiring more people, but also having to pay more for those folks. They're talking about incremental $2 billion of just inflationary costs alone. Now, another reason why the stock's getting hurt is because they're guiding to only 3 to 7% growth for next quarter. And this is problematic when you factor in that, let's consider their different segments, and we'll talk about their segments in detail, but they have one core assets that continues to grow at hyper speeds, and that is their AWS segment, Amazon Web Services segment. That's growing 30% plus. And so if you're saying, yeah, consolidated basis, we're only growing 3 to 7%, that means the rest of your operations are struggling to grow, and that might just reflect the broader macro concerns that we're starting to see, like a decline in GDP in the first quarter. Now, what is Amazon worth? Now that it's down about 13%, now it's down about 30%, nearly 30% year to date. Where's the stock go from here? In order to understand, think about the valuation, let's always split it up. What are the different segments? The core segments, and by revenue, it's North American, operations, then international, then AWS. Now, honestly, I don't like how this is broken out. They do break out, a lot of additional detail in terms of what's their revenue, but you don't really see the profit contribution by very specific revenue drivers. By these three segments, they do show the profit drivers where AWS is 30%, 35% profit margins, and North America is low single digits. Now it's at a loss, and international is also at a loss, has historically had trouble getting to profitability. But there's a lot of different pieces under those segments. You have the Prime memberships included in that. That includes Prime, the educational aspects. You have the infrastructure that they're building out that's included in that. So the question is, what's all that worth? And we'll talk about that in a second when we consider their different valuations. But they arguably, just because one segment, let's say North America, is the biggest piece of pie, that doesn't mean it's actually worth the most. I've done a previous video, once again, breaking down the individual revenue drivers beyond these segments. But once again, that doesn't tie to profitability. So it is a lot of assumptions go into it. So in this video, we are just going to focus on the three segments that they do break down in terms of profitability, showing North America, their largest one by revenue, showing up 8% year over year in sales, $285 billion in net sales over the last 12 months. But you are seeing that huge swing in profitability, and I called that out earlier, making a lot of investments to keep up with demand. And now they're going to start saying, hey, we need to cover these investments that we've made in labor, in infrastructure, in fuel costs. These things need to get paid for. But currently, this North American operations, that this is the seed that started Amazon, arguably they still aren't at scale. Now that's partly because they're at scale, they're just not at profitability. And the challenge is that there's a lot of different pieces under this umbrella. You look at international is once again unprofitable, and they were actually down 6% year over year. Now part of this is challenging to say, hey, what's your actual growth rate? You do have some Europe-specific aspects. A lot of people know about the humanitarian crisis going on with, Russia, invading Ukraine. And so, you do have some aspects there. But really what's going on is it's hard to get a clear growth rate when you had a spike in demand during pandemic. And now people are starting to adjust, saying, hey, I'm happy to go back to physical offline shopping. So that does affect their growth rate. And so then looking at their last segment, the AWS segment, this is just continues to rock out. This is 37% growth year over year. You're looking at $18 billion in revenue in the quarter, looking at net sales of $67 billion over the last 12 months and 35% profit margins. They're posting great results in their AWS segment, providing the critical internet infrastructure for a lot of different companies, providing the computing, power for a lot of different companies. And so the question is, what's the value for AWS? What's the value for this, this core asset? And when I consider looking at this, I'm looking at a business, once again, growing quickly. I'm looking at margin potential. I'm assuming margins actually go down over time because they're facing tough competition. And this is a data point worth considering, is that both Google and Microsoft are rapidly trying to take share from Amazon. They see, how big they are, but Amazon is still crushing it. So that is a data point that you want to consider, is like, yeah, they're still growing and they're expanding margins. This is, a very solid business, this AWS segment alone. And so thinking about what's their growth rate over the next 5 years, I'm assuming, let's say somewhere in the 20s, low 20s to high 20s% growth annualized over the next 5 years, assuming margins actually come down to deal with some of the competitive dynamics. They're currently at 35%, let's say 28 to 32%. So this is trying to bake in some conservatism, assuming effectively a 20% tax rate, assuming an N multiple, because this is such critical infrastructure for a lot of different companies. I'm assuming you get effectively a utility type valuation of around 30 times earnings 5 years out. And this implies that relative to the current market cap, this value for AWS, Amazon Web Services, is effectively $1 trillion to $1.7 trillion. So that's effectively saying, yeah, this business is worth potentially more than the entire market cap, where you're effectively getting their retail operations for free. So then the question is, does this imply that it's deep value? You got to start asking yourself, well, wait a second, what are the retail operations worth? If you're effectively penciling out a range where AWS alone is currently worth Amazon's market cap, let's say within 5 years, where it's either 80% of their market cap or 130% of their market cap. In order to have a great return from here, you're going to need to say, yeah, the retail operations are just going to need to be great. Like, you're going to need to pencil out a situation where those retail assets, you're going to say, is going to be worth a lot. And so let's talk about that in a second. Let's try to understand, thinking about this. And so this is, once again, this is a hypothetical valuation framework. Of course, stock prices can go way higher or lower. And keep in mind, this is not financial advice. This is educational. I'm trying to share my own personal take thinking about Amazon. So currently around $2,500 a share. The new diluted shares outstanding, $1.3 trillion market cap. And so, yeah, you look at AWS, and that could be more than the entire market cap. But in order to get a great return, you need to see significant value contribution from North American ops and their international ops. So the question is, what are these worth? And I pencil out a range effectively from, let's say, $300, $400 billion to maybe $700 billion. And, that's really driven off of, assuming, let's say, mid to high single digit growth, maybe even low teens. But then the question is, what are their margins ultimately? And that's a really tricky part. That is literally $1 trillion question for Amazon, is where do these margins end up shaking out? Because you have a lot of really interesting assets there. You have advertising revenue, which should be really high margin. You have Prime revenue, which also, this effectively the subscription driven revenue that should be higher margin, but they constantly reinvest, into their physical infrastructure and, making better warehouses and expanding. So they're not showing it really with their current profitability. They're saying, hey, we made all these investments. So it is challenging to say, hey, is this, crazy upside potential? When I look at this, thinking about these different segments, we're effectively getting maybe 6% margins for both North American ops and international. That's the question, is could they be much higher over time because of the mix of business? I'm not sure that they could be, but, let's say they get to mid to high single digit margins and they're growing somewhere between 5 to 10% growth annualized in the years ahead, then, you're kind of penciling out around $2.5 trillion in value, or nearly 100% upside from here. So I don't personally view this as a deep value play. And that's the reason why I'm not going all in on Amazon stock right now. I think there are other plays out there, some of which I call out to Unrivaled Investing subscribers, each week, trying to call out potential actionable ideas. Some of them are deep value. Some of them are, growth at a reasonable price. Some of them are special situation. And in all honesty, my view with this market is you need to find, you need to consider all those different types. The market that we saw the last few years were almost any sort of growth asset got a bit higher. That market is over, as people are, probably well versed now, as they've seen a lot of their stocks get hammered. So I think the market now is, let's see what are the things. Like special situation stocks are great because, if the market completely collapses, you have ideally the value isn't going to be impacted. And sometimes that's, merger arbitration, merger where arbitrage, where it's like, hey, will this deal go through? And if the deal goes through, you'll make some money. So I'm looking at Amazon, and it's tied to the economy. They're talking about lower growth in the quarter ahead. I'm looking at their North American, their international ops. I know they're worth a lot. The question is, what is that worth, especially given the fact that they're currently unprofitable. Now, they're investing in a lot of things, and also, management has said a lot of really smart things over time. Now, you do have a new CEO in place, and, Jeff Bezos is figuring out how to get, space infrastructure out, flying around the galaxy, and, I think Blue Origin. And so, he's got his other projects now. But, looking at Amazon, you think about some of their past quotes where they would say things like, the results today are the products of the last few years of investment. So, whatever we're talking about today really didn't do anything. It's really the investments we made the last few years. And so I understand that. And a large part of what's driving their results is also the economy as well. If you see a weaker economy, you see dramatic changes with the pandemic, it's harder, all of a sudden there's a lot of online demand and now it's pulling back. Yeah, it's harder, for them to be able to continue growing in that situation. AWS does seem like that's a very clear runway for continued growth. And on the flip side, you might say, hey, isn't it great that they're actually burning a lot of cash? I want to consider all different angles, because when they're burning a lot of cash, doesn't that mean they're finding a lot of investments? And given their track record of creating a very strong value proposition, isn't this something where you go say, hey, I want to trust them with this? Like, maybe they're making a bunch of smart bets. So, and this is the reason why sentiment plays such a big role with a company like Amazon. When you haven't proven out your margins, in one given quarter, you might show a cash burn, but because sentiment is bullish, people go, oh, that's great. This means you're making long-term investments. You're going to grow faster in the future. Whereas if sentiment's bad, arguably like right now, then people are going to go, oh, you're making these cash burn investments and your growth isn't great. Why would I want to own this stock? And so sentiment, obviously, in the near term, sentiment plays such a big role in terms of valuing these businesses. That's why I try to focus on the value proposition aspect. When I look at Amazon's value proposition, I continue to think, yeah, they continue to solidify their value proposition incredibly strong. But the question is, what's the value for those, let's say, retail assets, both online and offline? And their AWS clearly incredibly strong. But I'm not able to pencil out something where I'm saying, yeah, this is 200, 300% upside from here. I'm able to say maybe 100% upside, in one scenario, maybe. I just think personally, and the reason why I'm not backing up the truck here is I think there are personally other ideas, and I call out ideas each week at Unrivaled Investing, where I'm calling out things where it's like, hey, maybe there's a couple 100% upside here versus what I'm penciling out here. Anywho, if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.